I've spent the last decade helping high-income professionals untangle complicated compensation. And one of the most common expensive mistakes I see, smart, successful people either massively overpay estimated taxes or underestimate them. Neither is strategic. The IRS penalizes underpayment, but it doesn't reward overpayment. If you send too much money too early, it just sits there, not compounding, not reducing stress, not building your wealth. So the real question is this: is your money working for you or sitting with the IRS months early? Let me share with you a client story. They weren't trying to avoid taxes, they were trying to avoid surprises. Every April felt like a punch in the gut. They would file their return and owe far more than expected. And every year, they'd say the same thing: we make great money, why does this still feel chaotic? So they met with a CPA and asked, what can we do so this doesn't keep happening? The answer? Buy rental properties for the depreciation. Not necessarily wrong, but completely misaligned. They didn't want to become landlords. They didn't want another asset class. They didn't want tenants, repairs, or more complexity. What they wanted was predictability. When we began running projections for our clients during the year, two things changed. One, they stopped being just blindsided. And two, they stopped reacting emotionally. No more April panic. No more scrambling. No more feeling successful at work, but behind at home. Estimated taxes aren't about paying less, they're about knowing what's coming. Let's talk about the safe harbor rule. Most high earners assume they need to perfectly match this year's tax bill. You don't. The system runs on what's called a safe harbor rule. If your adjusted gross income is over $150,000, and for most of you it is, you avoid underpayment penalties as long as you pay in at least 110% of last year's total tax liability. Not this year's guess, last year's actual number. So, if last year's total tax was $120,000, your safe harbor this year is $132,000. If this year ends up being $150,000, you might owe in April, but there's no penalty. Now that you understand the guardrails, let's talk about why so many smart professionals overshoot them anyways. First, there's the fear of penalties. High achievers hate mistakes, but safety and strategy are not the same thing. 2, supplemental income withholding rates. Bonuses and RSUs are typically withheld at 22%, but many of you are in the 32 to 37% marginal brackets. So when a $150,000 bonus hits and only 22% is withheld, your first thought is, I'm short. Flat supplemental withholding creates uncertainty, and uncertainty creates overcorrection. The third is the time trap. High earners are busy, simple and direct. You don't want to pull last year's returns, you don't want to run projections, you definitely don't want to recalculate every time an RSU vests. So you shortcut it. Just increase withholdings and forget about it. Let's send an extra $20,000 and move on. Shortcuts remove the mental burden, but they remove precision as well. Let's make this concrete. Imagine you overpay by $25,000 per year, just to avoid any chance of being short. That $25,000 earns zero at the IRS. Now, take that same amount at 6% compounded over 10 years, that's roughly $330,000 in your pocket. Timing matters. Cash flow flexibility matters. Estimated tax planning done correctly doesn't eliminate taxes. It eliminates surprises. And when surprises disappear, decisions get calmer. Calmer decisions lead to better capital allocation. And that's where this gets bigger than quarterly estimates. Because if you're earning $300,000 to $500,000 plus in your 30s and 40s, you're not just building wealth, you're building future tax exposure. The real question is this: do you want your future income controlled by tax law or controlled by you? If you want to see how to intentionally build taxable, tax-deferred, and Roth buckets while you're in your highest earning years, Click right here and watch the next video on tax diversification.